It's been a volatile period for the oil markets, with concerns about demand stemming from the uncertainty around the coronavirus, temporary shutdowns to manufacturing, flight restrictions, and this general sense of nervousness have been impacting the broader commodities complex as well.
Seems to be the key level at the moment is $52 a barrel on WTI. But I think this is the move in gold makes us maybe mistrust the rebound in the oil market, because you can see that the underlying theme, there is an underpin of safe haven demand, which is pushing that gold price up.
Hello and welcome to IG's Trading the Markets podcast. I'm Victoria Scholar. Now, with me to discuss how the coronavirus is impacting different commodities is Sean Murison, market analyst at IG. Sean, great to speak with you. Let's just kick off with a broad question. I mean, from where you're standing, how have you seen the coronavirus playing out in the commodities markets?
Hi, Victoria. Yeah, I mean, I think if we look at it holistically, it's a net negative for the commodity markets. If you look at copper as being a sort of a leading indicator for economic health, it's down around 10% year to date. When you start adding declines in all the base metals, iron ore, nickel, aluminium, as well as the natural gases, or liquid natural gas, they've all been trading lower since the news of the coronavirus outbreak. We are seeing a little bit of relief now in some of the markets in the short term, but generally the overall momentum is negative for the commodity space, and that's of course excluding gold, which has been finding quite a strong safe haven bid.
Yeah, so you pointed to that sort of short-term relief that we've been seeing, because the latest data is showing that the new cases are starting to dip in mainland China. Do you think that's just a short-term move before that sort of medium-term downtrend within the complex continues amid those concerns, or is there a chance that some of the risks around this have been overstated?
Look, I don't think the risks are overstated at this point. I mean, some of the estimates for, and we know that it's going to weigh on economic growth. I've seen some estimates for first quarter GDP out of China as low as 1%, and we could drag a full year GDP down to 5%. A lot of unknowns. So at the moment, what we have with the coronavirus is, I think it has been quite well contained. When you look at, I think it's more than 3/4 of the fatalities are still restricted to mainland China. I think what is helping the commodities is that you are seeing, the Chinese authorities stepping in and trying to assist that market. They've extended their medium-term loan facilities to banks. We are likely to see further stimulus measures in terms of benchmark lending rates being cut. Previously, we've seen a liquidity injection into the financial markets. So I think those are signs that China is doing what they can to try to stimulate that market, and that is probably why we are seeing, we have seen a bit of an uptick in the short term, whereas the longer term picture, the trends are still down.
So let's dig into one sort of subsector, the oil markets, because we've seen some really big gyrations within the oil space this year. But most recently, it's been rallying by about 7% since those 2020 lows just last week. So can you tell us a bit about what's going on and how that links back to the coronavirus?
Okay, so China is the largest importer of oil in the world. I think that's something like 14 million barrels a day of crude that they are importing. So when the news of the coronavirus broke and the epidemic struck, we've seen quite a that 20% correction from the highs in oil. So actually putting it into what we call a technical bear market. What we have seen since then is a minor recovery. It is still trading lower for the year, crude prices. So it's an indication that the market is recognizing some of the efforts by the Chinese authorities to stimulate their economy, to provide support to that economy. I think you've also got a couple that, while that is a major factor affecting the crude market, we also have, we've got to look at what OPEC Plus are doing, and reducing, curbing supplies to the market by another 600 barrels looks to be the what OPEC Plus have planned for the crude market. So that would have given a bit of a buffer to oil prices in the short term. But it's not out of the woods just yet, although we do have some short-term technical signs of a reversal in those markets.
Yeah, so you mentioned those sort of short-term technical levels. I wanted to ask you, what are the kind of key levels to watch? I mean, if we look at WTI, we were up around $64 earlier in the year. Now we're kind of heading back more towards the $50 mark, although short-term we are kind of on the ascent. Do you see the next levels to be tested as 50 on the downside, or are we looking more up towards 55 and possibly 60 once again?
Okay, so what I see is we've had the downtrend. That downtrend has been ended with what we call in technical analysis a double bottom, the reversal sign. Seems to be the key level at the moment is $52 a barrel on WTI. If we can stay above that, then I think we can start looking towards a move back to about that 54.50 level, and above that, maybe even as high as 57 if we do start to get momentum. But at the moment, our short-term key level there is about $52 a barrel.
Okay, let's move on to gold now. Obviously another commodity, but with very, very different dynamics, because this is a commodity that's been performing extremely well lately. We're back above that $1,600 mark, and momentum clearly with the bulls. It's interesting because, on the one hand, we've been enjoying this 10-year bull run for equities and a lot of risk-on sentiment in the markets. Yet this is a very risk-averse, safe haven asset, and it's clearly been attracting a lot of investor attention and flows. So what do you see in terms of the price action ahead? Is this an indication that there is a lot of nervousness out there?
Well, I think this is the move in gold makes us maybe mistrust the rebound in the oil market, because you can see that the underlying theme, there is an underpin of safe haven demand, which is pushing that gold price up, and I'd give that even more credence, the move up in gold, and the fact that the dollar has been relatively strong over the last little bit, so it's not a weaker dollar play. It's been a safe haven dollar play. I think this move above $1,600 an ounce is quite substantial. It shows a market that had been consolidating over the last couple of weeks, now continuing the upward trend, and so that momentum looks relatively strong. So at the moment, gold looking set to continue gains in the short term.
Okay, I wanted to ask you what you think about one of these potential risks, because we know that a lot of demand for gold stems from China. So would you say that the coronavirus could temper gains for the precious metal if it results in fewer Chinese buyers?
I think at the moment gold is quite speculative and is quite sentiment driven. So maybe there would be a demand factor from the Chinese. I know that one of the big markets for gold is also India. I think if you start seeing cases of the coronavirus and an outbreak and more of a pandemic type situation into India, that could affect the longer term demand for the commodity. But at this point in time, I think it's acting as a safe haven, a store of value, rather than looking at the demand from China, as maybe the oil price is. Yeah.
And what about kind of the interaction with inflation? Because when we look at Chinese prices, we know that there's been this massive spike in food prices lately. That's because of the coronavirus, and a lot of investors use gold as an inflation hedge. We know that inflation levels around the world have been low for some time now. So if we do see prices pick up again, inflation rear its ugly head, could that spur demand for gold as well?
Yeah, safe haven demand for gold. I mean, gold is an inflation hedge. I think you've answered the question there. What I will add as a caveat to that is, while that you've got the gold on the move, you do have the commodity oil, which is under pressure, and that would be negative for global inflation.
All right, Sean, that's all we have time for today. Thank you so much to my guest, Sean Murison, market analyst at IG, and thank you for listening to IG's Trading the Markets. I'm Victoria Scholar, and make sure to tune in again next week.